And unlike the other seminars in which where I'm introducing the speaker, this happens to be my own paper together with a group of researchers who are Désiré Kanga, whom when we started this research, Désiré Kanga was a postdoctoral research fellow in the Center for Global Finance at SOAS University of London. He's now working with the International Monetary Fund in the US. And the second co-author of this paper is Professor Lemma Senbet at the University of Maryland, and Professor Issouf Soumaré and the Department of Finance, Insurance and Real Estate and Lab for Financial Engineering at Laval University in Canada. Now, this work represents a series of papers that we have produced in the last couple of years, some of which have been published in a number of journals, and some which are still work in progress, including this one, and some which are being reworked into a big volume with contributors from other researchers. The common theme among these papers is to try to study the behavior of Pan-African banks. Okay. To study the behavior of banks which have shifted the ground of banking in Africa, with the hubs of these banks in Nigeria, another hub in Morocco, another hub in Kenya, and another hub in South Africa. And some of these banks started with the very modest beginnings, mobilizing finances for capital investment for small companies. And somehow they were able to innovate in many ways, align themselves to the market demand and raise to become real big conglomerates. So this is the whole concept of the Pan-African banks on the rise. And some of the papers we have looked into issues including liquidity. We've looked at issues including risk in a number of papers, and a previous paper in the Journal of Banking and Finance, a recent paper, the close of last year in the Journal of International Money, Finance and Markets. But this one is unique, and let me explain the uniqueness of this paper, which is basically trying to look into interesting issues of bank competition and financial inclusion. Okay, I'm not sure where the control presenting. Okay, it's working. Okay. Now, to do this, let me first just give a little bit of a background. And if you want to intervene, please, stop me and intervene. Alternatively, you can post a question, a comment, an observation in the chat, and Dr. Mengshi will draw it to my attention, and we can have discussion on the issue. But of course, at the end of the presentation, I'll be happy to not only take questions, but also look at constructive comments and suggestions, because this is really a work in progress. So in terms of background, banking, of course, in Africa has gone a long way. And my recent volume, edited with the Dr. Patrick Njoroge, the governor of the Central Bank of Kenya, traces all the developments of 50 years of central banking in Kenya. What we learn from, so for example, the recent volume I edited with Patrick last year, is that the fact that the banking systems have gone through a huge and considerable journey, in terms of the businesses, the nature of bank lending, and so forth. But so we characterize some of these financial systems. Some of them are small, some of them lack in depth, and some of them maybe the nature of financial intermediation is not more efficient. However, this is not a kind of generalization without exceptions. There are very important exceptions, and this is why we come in with this idea of Pan-African banks. In the sense that they build on the need for household access to finance and firms' access to finance and understanding the local markets. So the recent change in the African financial landscape is basically the increase in Pan-African cross-border banks, as I mentioned, especially on some of the hurdles that I have identified. But of course, this raises a number of fundamental questions to the understanding of banking, and especially even cost and margins, the cost of banking, the profitability of banking, that, fundamental question that we have to address. And in fact, the literature, over the last, 5 years, 5 to 8 years, has looked at some of the behavior of banks, in particular trying to make a distinction between the domestic banks owned by residents of the country and foreign banks, which are owned, the majority ownership, more than 50% being the foreign investors. And there are many messages coming from that literature. But a particularly important message from that literature is that the origin of banks, the very origin, whether we started by local entrepreneurs or by international investors, that does matter. And the work by Beck in 2015 shows that and identifies, the origin of bank very important. At the paper, Désiré, Kanga, and Issouf, Soumaré, and I published in the Journal of Banking and Finance 2020, it does play an important role and see where foreign banks excel and where domestic banks also do well in terms of delivering financial intermediation. And of course, the work by Periti in 2018 also, JMCB, which draws some attention of some of the important peculiarities, especially the nature of bank lending and a bank investment into a capital markets activity. Yeah. So in this paper, just to give you a short route map, the journey that we're going to take in the presentation, is that we're going to look at exactly what do we know, okay? That is the existing literature and what it does tell us. It's good that we start our discussion on the basis of what a current research has covered. We then emphasize the motivation. Why do this study at all? We then also follow the formulation of the research questions that we investigate and the methodology that we invoke to be able to carry out the investigation. And then also, what do we find? We'll just share with you some of the findings, some general findings, and the particularly interesting findings which are coming to the fore for the first time ever. In other words, which have a high value of additionality to the current knowledge. Then we end up some conclusions and the implications of these conclusions for public policy, including regulation, as well as private practice, including bank management. Okay, so let's start from what do we really know based on existing literature and current knowledge. Some issues have featured prominently in banking, say over the last 20 years. One issue has been the issue of bank market segmentation. Okay, and the segmentation is just to point some amount of the dual existence of foreign banks versus the domestic banks, in which basically foreign banks are more involved in investment banking, and also some premier commercial banking activity, and some amount of cherry picking as well, leaving some with the domestic banks to concentrate on some residual kind of activity. And therefore, where the risk is likely to be higher, the costs are likely to be higher, and therefore our profitability is likely to be depressed. And this is what covered in the work of Stigen, Claessens, and Van Horen in the JMCB 2012. But there's also literature about bank efficiency and international trade in financial services. In terms of bank efficiency, you have a conclusion reached by Chihaka and Bodier in 2005, among others, that foreign banks are more efficient and active in lending. Of course, in lending, the efficiency could be achieved at a lower costs for higher volume of trading, the conversion of inputs into outputs, but also this could be happening if the banks are specializing in some of the core businesses where they are dealing with, for example, multinationals. But the role of the banks in international trade as financiers and also for quality control, for trade documents, here the foreign banks are supposed to play an important role compared to domestic banks, and the work of Claessens and others in 2016. And especially if the trading companies are also affiliated the headquarters of the foreign bank. And the evidence that in general, the emerging market banks and the global banks are consistently outperforming domestic banks in some areas, and especially due to higher operational efficiency, low cost of funding, and where segmentation of business there is no kind of strong evidence. Okay, in the loan markets, that's the paper of Peretti in 2018. And this tends to actually kind of say, okay, maybe those domestic banks, they may not stand a chance of greater competition. Okay, but then this literature one needs to look at very, very carefully and cast doubt on some of these findings, or find a way of reinvestigating some of the issues. No, for example, as a departure from the literature I've just discussed on bank segmentation and others, Beck and others, and Clark and others, find that cross-border banking can positively affect lending. Okay, it can actually lead to higher lending and improve competition in the banking industry, especially focusing on some of these. And Kodongo's work is also relevant in 2015 and beyond in 2016. So we could argue that the presence of foreign banks may increase concentration in the banking industry, but these foreign banks will do very well where there is some cherry picking, which may negatively affect the overall our local credit extension, creating some amount of financial exclusion. But we have to bear in mind one point, that foreign banks are not one size fits all, and that actually the behavior of foreign banks is not entirely homogeneous. On the contrary, the behavior is heterogeneous. It can vary from one large bank to another, among banks of different sizes. It can vary from one country to another, even within the continent of Africa, and also can vary over time. This heterogeneity and time-consistent variations are very important considerations to take into account if we are to embark on some new and promising investigation, just as we are doing in this paper, where we are focusing as an objective to study the activities of cross-border banks, stemming from the recent rise of Pan-African banks, and see how this affects the level of bank competition in a particular territory. And I will explain why in a moment, why we're focusing on this territory. In the West African Economic and Monetary Union. Okay. And whether this change in competition can ultimately deliver the impact on financial inclusion, that is on bank lending and enabling the firms to access finance. Okay, because that's the ultimate reason of financial kind of intermediation. And that's the focus of this paper that I'm sharing with you today. Now, framed this in terms of research question, is that starting from the overall broad brush of investigating the effect of cross-border Pan-African banks on competition lending in the WAEMU, West African Economic and Monetary Union banking sector, we aim to provide answers to the following 4 questions. Question 1, does cross-border Pan-African banking increase bank competition? Okay. Direct question, direct effects. These are direct effects on bank competition. Secondly, what are the effects of cross-border Pan-African banks on bank lending, given the competition? And thirdly, does the increasing presence of these Pan-African banks on the continent, cross-border across a number of countries, alleviate the credit constraint facing firms in the region? Okay. And are there some kind of cross-country variations within the WAEMU region in terms of observing these effects or analyzing this evidence? So this is a way of taking a straightforward question of the effect of cross-border banking, cross-border Pan-African banks on competition and lending behavior in their WAEMU countries, and splitting it into 4 interesting issues that we can investigate using our methodology. And I always prefer to just highlight some of the findings, before we go very far, just in case this presentation doesn't confer worries on that. Just to to see what you would be expecting. What is interesting about this this research is the evidence that cross-border Pan-African banks do enhance competition in the WAEMU banking system, but also that this enhanced competition actually delivers financial inclusion by increasing bank lending. And the financial inclusion is particularly relevant here because the bank lending is specifically for enhancing farm access to bank credit. And that this effect is higher with cross-border Pan-African banks compared to any other banking cohorts that we have in the region. And these are the main findings that are new and, of course, with a lot of implications. But let me just explain a little bit about the laboratory or the background where we test the hypothesis and the data analysis. The focus is on WAEMU, the West African Economic and Monetary Union, because of its uniqueness. It is unique, and just showing here the geographical location of WAEMU on the African continent here, that this shaded area here, like a big chunk of the total area map of the continent, okay, is unique because it includes 8 developing countries. And these developing countries, they share a common currency, the CFA franc, which is pegged to the euro. And these countries are not homogeneous. They have got variations among the 8. There are some sharp variations. For example, Cote d'Ivoire or Ivory Coast and Senegal are lower middle income countries. Benin, Burkina Faso, Guinea-Bissau, Mali, Niger, and Togo are low income. That heterogeneity is very important, even when these are operating within the same central bank, sharing common currency that is pegged to the euro. Okay. But there is another interesting feature of WAEMU. WAEMU features a financial system where banks are the predominant source of finance for businesses and households. Okay. The role of banks in the official financial system is particularly important. And so the investigation should be very special because it takes a very special zone, a special area. And I think only the African continent is very unique, apart from the CIFA, Central Africa, CIFA, where you can get a group of countries. And maybe in the southern regional, blocks like Commerce and others, that has not been achieved in terms of going towards a single currency. So there is some unique experimentation. So the four main reasons why WAEMU focus has a single regulatory framework. On the 1st of January 2018, they adopted Basel III, with the Basel III as a template for a bank regulation, emphasizing especially the capital buffers as a way of safeguarding the viability of the bank and the sufficiency in capital resources. But it's also another interesting aspect that this banking sector in WAEMU has been for quite some time been dominated by French banks until recently, until the emergence of Pan-African banks. Now, the third important component on WAEMU is that I think all of us scholars who've been looking at bank behavior in many countries in the world, including OECD countries like UK, US, as well as developing countries in Africa, Asia, and the rest of the world. The tendency has been, I could actually go back a little bit. If you go back like 30 years ago, getting hold of bank level data was a nightmare because the central banks wouldn't release the data. Then Fitch Ratings introduced bank scope, and that really made a revolution, increased the amount of work done on bank level data, the microeconomics of banking. Okay, so most of the studies in the last 20 years have relied mostly on bank scope data to construct a sample of banks, and have panels of high numbers of banks with a high availability of our time series, the N times T. Okay. In this particular case of this paper, we were able to access data that is much more informative than what is available in the bank scope, to the generosity of the Central Bank of WAEMU, which are going to provide a lot of information that would be sometimes be missing in the bank scope data. And so there is, unlike in the past where there has been less attention being paid to the WAEMU region banking sector using micro level data, this data is absolutely which we use. So here is a region that becomes an interesting laboratory for investigation of very pertinent question in banking and research, in research and banking, focusing on that. And just to give you an insight into the nature of the data, this bank level data which we hand collected from annual balance sheet reports of banks operating in WAEMU 2000 and 2015, and which we are currently updating up to 2020. When you look at this sample of banks, you see that there is relatively a high number of banks in the sample in each country. The lowest is in Guinea-Bissau, 4 banks. The highest is in Cote d'Ivoire, a lower middle income country, over 27 banks. In general, our sample has a real huge staggering of 121 banks. If we had relied on bank scope, the highest we could have gone is to 84 banks, because in some of the previous studies, we had relied on bank scope before getting access to the WAEMU Central Bank. So the hand-collected bank level data gives us more degrees of freedom and to be able to pursue asymptotic accuracy of the econometric results. And we're also interested to see how many of those banks in each country are listed on the stock exchange. Listing is particularly important because the listing of the bank on a local stock exchange also provides an additional angle on corporate governance by being able to reduce agency problems, whereby information is available, the share price changes according to new information, according to the efficient market hypothesis, and therefore provides an angle. The capital market provides an outlet as an extra level of corporate governance or monitoring of the activities of banks. So among the 121 banks, the listed banks are only 10. Okay. One in Benin, two in Burkina Faso, 4 again highest in Cote d'Ivoire, no listed in Guinea-Bissau or Mali, and then 1 in each of Niger, Senegal, and Togo. Okay, and this is the nature of the sample that we deal with. I think it is higher quality. And before we go into this, I just want to have a kind of a look into an identification problem that happens when people are talking about foreign banks and Pan-African banks. The literature over, let's say, 20 years has actually created this dichotomy of domestic banks on one hand and foreign banks on the one hand, and looking at then studying the behavior of both banks, together, how they interact. Say, for example, in normal banking, also how they interact, for example, in the interbank market. Some of the studies that Thomas Murinde and others in the audience have been doing, separating foreign banks and domestic banks, and then look at interbank market behavior. Now, in this specific paper, the foreign banks have a kind of 2 categories. That's one kind of use a standard kind of Venn diagram, whereby the Pan-African banks could be foreign banks if a Kenyan bank goes cross-border and operates in Tanzania or in Uganda or in Rwanda, these are neighboring countries. Okay. In that context, it is a foreign bank in that country, but it is also a Pan-African banks. Okay. So all Pan-African banks are foreign banks when they do their activities cross-border. But of course, not all foreign banks are Pan-African banks, because the family of foreign banks, including, for example, multinational banks, the Barclays, Standard Chartered, and others, okay, which have rules and have some of them have been running for more than 60 years. So I thought we should highlight this to actually make kind of a clear distinction of identifying domestic banks, foreign banks, Pan-African banks. This identification is germane, very important to the empirical investigation taken in this paper.
Hi, Victor, sorry to interrupt. I see
Yes.
a comment from Jadip in the chat.
Okay. Go ahead, Jadip.
Oh, sorry, Victor, I didn't want to interrupt. It was just a quick clarification question. I wanted to know if the banks typically become Pan-African by acquisition or by expansion, and do they tend to be listed in one country or in a home, in a home country, or in multiple countries?
Absolutely, very, very, very good question. I can, in my explaining, should have given this as a background. The Pan-African banks are unique type of banks on the African continent. They showed a very successful experiment whereby indigenous banks in some African countries started indigenous banks. Some of them actually starting as microfinance organization, small banks, but being able to actually align themselves to the market demand, being able to respond to the needs of businesses as well as households, and doing that, being able to expand and gradually compete with foreign banks and even outcompete foreign banks and become dominant players. Okay, and I mentioned the origins, the predominant origins of the African continent of these banks were the banks in Nigeria, which has quite a number of banks that are in the Pan-African banks category, and which have been able now operating almost across the continent. You can find Nigerian banks in Southern Africa. You can find Nigerian banks dominating West Africa, and finding Nigerian banks in Eastern Africa. Okay, and then the other half, of course, are Moroccan banks, which operating all the way to South Africa, but started initially as indigenous Moroccan banks, grew and started competing, especially competing against French banks. The third is Kenyan banks, whereby these indigenous Kenyan banks that started small have expired and are actually spawning the rest of the East African East African area. They are present in all of these, and of course, South African banks, which started, indigenous banks, but they have actually also dominated the Southern African frontier. Yeah, so this is some of them started that way. Some of them may have merged, and some of them may have acquired other small banks, but the growth was phenomenally indigenous. And the idea of cross-border banking, of course, is made possible by liberalization of the introduction of GATS, the end of the introduction of WTO, and allowing international trade in financial services, where countries are able to open up their banking sector to, especially for cross-border banks in the neighboring country. And this is the kind of the source of where these banks are classified. But I can give you more straight on this, JD. Thanks very much for that comment, which remind me to go back and explain how did they start, and how they have expanded over time, which actually leads to your question very much motivates the next slide. So quite timely to see if you take, for example, a 15-year horizon, okay, and you compare, say, starting 2000, say, the 60% base, more than 60% foreign banks, okay, in WAEMU, okay, and then about 30% being cross-border African banks. And you can see what has happened over time. The number of cross-border banks have expanded. Okay, did I lose my slide? Okay, I think
it's there. We can see it.
Can you see the slide?
Yes.
Okay. The problem is I can't see it. I need to be able to see it as well. Okay, so let me see how I can do this. Okay, just one moment. I should be able to hide it back. Okay, go back. Okay, go back to okay, got it. Okay, so as you can see here, the transitions over time. The red line is following the progress in domestic banks. Okay, domestic banks which are not a cross-border banking. Domestic banks which are on operating within the economy, the domestic economy, and they do not have extensions into the neighboring country, cross-border. But as you can see, this is the phenomenal increase here on the phenomenal increase in WAEMU of cross-border banking over time, okay? And even when the level of foreign banks is more or less constant during that particular period. And this is the kind of the actual phenomenal growth of cross-border African banks within the WAEMU region. Now, it is also helpful to configure both Pan-African banks and foreign banks in terms of the headquarters of the banks. And so what is done here is to look at the possible headquarter countries right away from Belgium to the US and the UK, and then take the entire WAEMU region and look at the distribution of the headquarters in this of the headquarters of these banks, say each year. So if you take, for example, the year 2000 as our starting point, we find that say there was 3 foreign banks from Belgium, 10 banks from France as in the WAEMU, and during to colonial heritage, the majority of the banks are from France. Libya 4 banks, Mali 6 banks, and Togo, which is another one of the mention of the hubs I should have mentioned, 8 banks, and in total 37 banks in WAEMU. 15 years later, in 2015, you find the distribution has changed. The Belgian banks the foreign banks with headquarters in Belgium is not in operation. Instead, you get one bank with a foreign bank, the Pan-African banks with headquarters in Benin. And then the growth of the headquarters, instead you find that the banks with headquarters in France are diminishing from 10 to 7. And then the growth of headquarters in Mali to 11, the expansion of headquarters in Togo at 14, we in the total banks operating in the region 78. And this is goes you to show you some of the emergency of or some emergency of the cross-border banks with the shifting of headquarters. And in this particular case for WAEMU, the dominance of banks with their headquarters in Nigeria, headquarters in Togo, headquarters in Mali, headquarters also in some of the Cote d'Ivoire of the WAEMU countries, including Cote d'Ivoire. Okay. Now, even when you want to look at the sample of this in terms of the bank soundness indicators, we find that overall the banks have grown in terms of soundness. Say if you look at the period between 2009 and 2015, and maybe this could be attributed to the nature of the cross-border banks. And if you take, say, categories of soundness indicators in terms of the, so for example, the nature of loans, the cost of loans or the cost of funds, you find that these comparisons are very convincing. Even when you look at the market share, say three largest banks in each country, and then you look at the market share in terms of total assets. Total assets are the lending, the creation of assets by banks. And you take these countries, you see that basically the market share has kind of changed over time. And that, of course, could be an indicator of competition, as we shall formally show in a moment. Now, we want to here show the competition more formally by using one of the indicators, which would be the construction of the Hirschman-Hafendale index, the HHI. The HHI is basically technically used to determine the market competition, the market competitiveness, the degree of market competition, which is the market competitiveness, and follows some parameters. For example, if you get a HHI that is less than 1500, this is considered to be a competitive market environment. But where the HHI is, say, between 1,500 and 2,500, this is moderately concentrated, okay, with less competition. And where the HHI is greater than, say, 2,500, then you can say the banking market is indeed concentrated. That may be due to monopolies in banking or the dominance, say, by foreign banks previously. So what you see here, for example, if we can take insight from Benin and Burkina Faso, you find that in Benin, in the initial period from 2000 to 2003, you had a very high HHI, greater than 2,500, indicating, yes, a high degree of concentration. That means it could be because maybe the banking market is monopoly, or the banking market does not allow entry by foreign banks, although this should be required by WTO GATS, which reciprocal treatment allows countries to be able to enter into a foreign banking sector. But then, of course, as the years go from 2004 to 2012, you find the HHI is a bit within 1,500, 2,500. So it's moderately concentrated. So the level of concentration actually goes down. Okay. And even when you look at Burkina Faso, as you You go from 2002 to 2015, you find that eventually Burkina Faso's banking market becomes competitive. Okay, so in a way, what the HHI is telling us as a measure of market competitiveness in the banking sector is to show that over time, the West African, the WAEMU economies have featured banks that have become moderately, competitive over time, and many factors could account for that. And there is a complete a strand of literature that addresses on some of these changes, including changes in regulation. Okay. So this is one measure. We shall be using this measure in our model to try to explain the competitiveness, and indeed which will serve as the main variable that we try to investigate. Also, one of these could be try to look at the differences to compare the differences by banking groups. If you take, domestic banks which operate only in the domestic economy, Pan-African banks as which a category, and you have to look at the differences in terms of market share or loan to assets, the nature of creating assets or lending, and also in terms of size. Compare this, say, domestic banks with Pan-African banks, French banks with Pan-African banks, that's purely foreign banks with Pan-African banks, and also domestic banks with French banks. You see that the market share of cross-border Pan-African banks is lower than those of domestic and French banks, according to this information here. But we can also investigate the behavior of Pan-African banks against French banks in WAEMU, and also, of course, against also domestic banks by looking at market power. And to investigate market power, we use a standard credible tool, the Lemma index. The Lemma index is simply the markup price over the marginal cost. So it's a deviation of prices from the marginal cost. Okay. And that could be is estimated from, say, a translong function, where you can estimate, you can get average cost from a translong function. You can also get marginal cost from a translong function by taking the first differences. Okay. And so we constructed the market power index for these banks and try to see that basically it is very easy to kind of isolate the behavior of French banks, purely foreign banks, from Pan-African banks. So how do we undertake the empirical analysis? We do a two-step type of analysis, whereby we first start by investigating the nature of competition, as the objective study or the objective of our study is. And to do this, we invoke a relatively straightforward model, whereby we are trying to study the behavior, the prediction of the nature of competition indicator in country J and WAEMU at year T. And this is represented on a constant and a variable that represents either foreign banks presence indicator or Pan-African banks presence indicator. And then this is then we have a vector with a matrix of control variables. These are the variables that have been found in the existing literature on bank competition, which has been quite a literature that's spanning over the years, on trying to answer the question, what really drives bank competition? What really drives bank competition in the literature includes bank level specific factors, but also includes macro factors driving competition. And these are all explored in the matrix of control variable X. And then we have also a country fixed and also time fixed effects added to this, and of course error term. Okay. And this I hear somebody trying to. Okay. Either if you post you can ask a question or post the comment in the chat, and the main will draw it to my attention. Okay, now a little bit to explain a how am I doing for time? I think I will do okay somehow. And then we explain the variables in the model, and because this is where the measurement factors come into consideration. So here we consider some of the bank characteristics, and especially the construction, for example, of the endogenous variable. They have in there Hirschman index, the sum of the squares of market shares of banks within the country banking sector, a straightforward constructed, which we have already shown, and also the market power, the Lana index explained here in terms of the deviation of prices from marginal costs. And then we take the micro level bank characteristics, which will be go into the metrics of control variables we have been sharing. We have discussed, including the share of bank assets in total assets in the country, the share of the largest banks, as was shown in the diagram. And then we have a code for explaining foreign banks, one if foreign on at 50% or bank capital zero otherwise, African or Pan-African, one if cross-border banks status is bank status, yes, or zero otherwise. And then we also take into account, of course, bank risk, which is an important concept. And the literature on banking offers various competing ways of measuring bank risk. But we prefer not to take a historical context, for example, which would be based on the bank, the writing off of bad loans or default loans. We instead construct a Z-score as a proxy for bank risk. And then we also look at the capital adequacy simply as a capital to asset ratio. And here we explore for other permutation of this. We also look into liquidity, the cost-to-asset ratio, and then the size in terms of the total assets. Importantly, the literature also on bank behavior recognizes a number of macroeconomic and institutional factors which are included in the metrics. In particular, there is this literature on, and my co-authors and I in this paper have another paper that looks at the bank pro-cyclicality or banks anti-pro-cyclicality. And here we looked at that, basically looking at the output gap, looking at the cyclical components of the logarithm of real GDP to see the changes in the business cycle that might actually affect bank competition because the lending that basically levels of high business, high demand, levels of depression and low business, low demand. So we have to control for that factor. Also control for overall pricing by looking at the real interest rate. And that could also be defined as a departure or a difference between the bank rate and the real interest rate. And then we also look at the nature of regulation, not necessarily in terms of the quantitative, which is captured in terms of the capital asset ratio, but in terms of the quality of regulation, the enforcement of supervision laws or supervision by the regulators. You could have a good regulatory, you could sign up to Basel III and have a regulatory instrument in place. That's one thing, but supervising and enforcing the supervision of bank in another. So we construct a regulatory quality index that we use here in this paper. And then we take into account, of course, a change in the regulation, especially taking into account 2008 capturing the capital change in the region. And so these are the variables we need to do in the investigation. Now, in our first set of regulations, just to pick some of the interests in the equation that we specified in the model we specified. We're trying to basically here highlight the evidence on the effects of foreign banks on market share. Okay. How do the presence of foreign banks affect the bank competitiveness in terms of HHI index, in terms of concentration and non-concentration? And what is interesting here is to see basically in one equation, the first equation here, the presence of Pan-African banks, and in the second equation, the number of French banks. So there are two regressions here I will summarize, which give a very clear message, basically, taking all of the other variables, aside or taken care of. We focus on those two interesting variables. We say the presence of cross-border Pan-African banks improves market competition, basically, in the WAEMU countries. A signal that is given here in terms of the change of the falling of the HHI as an improvement in market competition associated with Pan-African banks, but not association with the number of French banks. So that's one important set of new results for WAEMU. We also run further regressions, doing a number of controls and exploring for NSUs. And particularly here, we are trying to look at the model that is predicting bank market power using the Lana index, the deviation of prices from marginal costs. And interested again in the 5 equations reported in this table, interested in the behavior of Pan-African banks versus the behavior of foreign banks or French banks. And the 2 main observations, as you can see highlighted in where I've just cycled in the paper, on this slide, that basically that the presence of foreign banks increases price competition, okay, particularly in low and middle income countries, and also generally in the full sample, and that is associated, say, with this signal of statistical significance of 0.063. Okay. So the impact of the foreign banks, okay, is in lower middle income, and here with the middle income we identified Senegal and Cote d'Ivoire. But the Pan-African banks' presence improves the price competition in small banks, if you take into account the size of banks in the sample. And this we're going to push this further investigation later, and we try to loop in the other evidence, and then try to see whether we can make a general observation in terms of the improvement in pricing competition in small banks. So we bear that result in mind. There are other important variables which are here important, like loan growth, size, the interest, and so forth. But we just want to focus on the main areas of interest, being the presence of Pan-African banks versus foreign banks. Now, having confirmed that the Pan-African banks will increase competition, we want to see whether this ultimately will deliver a financial intermediation and financial inclusion in terms of the behavior on lending, the ability of the banks to be able to lend to businesses and households, but in this particular case, to businesses. As we know here, is to take a step back and reflect on the existing theories in the banking literature on how bank competition affects lending. There are 2 prominent theoretical predictions in the banking literature. One is the market power theory. The market power theory, and summarized here by the paper by Guzman in 2000 JBF, is that competition in the banking system increases lending by reducing the cost of finance. So the cost and margins, basically. Here, by dealing with this, in normally banks, higher degrees of competition compete in the same marketplace, and banks ultimately are able to exclude some of the costs where they can reduce costs without necessarily compromising the quality of the loan. And the reduction in the cost, of course, increases access, because you see, access or financial inclusion has elements, number one, in terms of the demand, the supply, the costs, and the quality. So cost is an important financial inclusion element. And here, the market power predicts that basically competition will increase lending because it reduces drastically the cost of finance. But there is there is a dichotomy, another way of looking at how bank competition affects lending. This is the argument that in the presence of information asymmetries and agency costs, competition can actually reduce lending by making it difficult for banks to actually internalize and take into account the cost of building lending relationships. Okay. And especially where banks are inherently opaque. Okay, that's the bank, they don't share information freely, among the courts and the rest of the world. So basically, which means the competition will actually increase costs, and instead of increasing and then reduce lending. So the cost increase ultimately results into reduced lending. This is the information theory. And as you can see, the market power theory is on the opposite dimension of the information theory. And hence, bank competition has two predictions: that it may increase lending as predicted by the market power theory, or it may reduce lending as predicted by information theory. What really happens in WAEMU is therefore an empirical issue. Cannot be resolved purely by looking at these two theories, but purely by actually constructing a model that can shed literature can shed light into the actual impact of bank competition in lending in WAEMU, given the indeterminate contradictory predictions in the existing theory. So today, to do this, we invoke a straightforward bank lending regression, in which we have Z as the endogenous variable, the loan growth of bank I located in the country J at time T across the 8 WAEMU countries. And then we have competition, which we have already, the competition indicator, which we've already explored in the previous set of results. We had foreign ownership, Pan-African ownership, as previously indicated. And here the control variables are relating to explaining really what explains the loan growth in the banking sector. Okay. And here again, we can take a number of control variables, drawing from the recent literature. And then we have the country and time fixed effects for the model. And now we also look at the way the estimated parameters behave using quantitative regression. We find that kind of insightful in terms of what we expect the relationship to be among the main variables that are included in the model. Now, just to share with you two sets of results. The first here is to see the impact of a bank market share in terms of HHI competitiveness on loan growth using quantitative regression. And so what we have here, basically, the results are in the box, in the red box shared here. Okay, and we are looking at it in terms of low income countries, lower middle income countries, and also taking into account the size of banks, small banks versus big banks. And then also we also compare the full sample of the banks that we're examining. And the results are, particularly interesting here is to show that the general results that following the entry of cross-border Pan-African banks, there is a creation of a favorable environment for loan growth, especially in low-income countries and in small banks. But also more important, the full sample, what we see in the full sample here, we see that, the French banks, very important for the French banks, very important also in terms of the level kind of competition. And then in terms of the, we also actually, it's the French banks which seem to be a kind of very influential in affecting a banker market share. Affecting loan growth through a bank share market share. We also look at here in terms of how the market power line affects a bank lending. And again, looking at the set of the banks, the African banks versus the French banks. The French banks actually seem to be absolutely competitive in this environment. We also explored some results, just to mention this, just in case. We tried to create dynamics in the estimation by looking at lag dependent variables, and the paper by Powell in 2016 tried to do this in another setting, looking both at the market power hypothesis and the information hypothesis. We also look at other measures of competition. For example, in the literature, the Boone indicator has been used, but it is very heavily criticized, and but we tried to find results for it, and we could not see anything new. And then, of course, the interpretation of the French banks and the indication that they do not improve in a competition. Now, we also want to look into the perspective that the increasing presence of Pan-African banks may be able to alleviate the credit constraints facing firms in the region, especially if they are actively lending to these banks, and therefore addressing the credit constraint argument of firm financing. We look, for example, at the farm level data from the World Bank Enterprise Survey. Okay. And we find that we can get observations on some of the waves of the survey, and not all countries were doing the same wave in the same year. So maybe apart from 2009, we find these are scattered over the years. And then we also look into the nature of we take the design this in terms of looking at the dependent variable either at access and credit by looking at specifying the access credit takes the value of 1 if a firm has borrowed from a bank, and 0 otherwise, just a measure of credit constraint basically. Then we have also of access to credit and then credit constraint. A firm is credit constrained if it does not have a loan and has not applied to a loan because, and then we explore the explanations in the data of why the firm may not have been able to take a loan. As you can see, we are able, first of all, to get insight into both interesting variables, the access to credit and the credit constraint, and showing that actually in each of the WAEMU countries, this is an interesting phenomena featured in both, not in equal proportions, but it is consistent with the argument about heterogeneity in the region that makes the work absolutely interesting. We also then explore the sample farm statistics in trying to control for farm size, micro level, small level, medium, large, and difference in sizes. Okay. Then using this, we're able to design for further investigation going into absolutely granular issues, a probability model of access to credit, where you take the credit access, a credit constraint indicator of farm I, then country J, then D, and then we have F for the foreign banks and Pan-African banks presence indicator, and then we have a matrix of control variables, and then we do a standard probability. Now, and then we are able to come up with interesting findings whereby basically we find the role of Pan-African banks in the full sample, The role of Pan-African banks in the small sample among small farms, the role of Pan-African banks also in the medium farms, and the role of Pan-African banks in the large farms. So across the distribution of these farms. This is not true with the other classification, but we also want to see the divergence between Pan-African banks and foreign banks, and say that basically foreign ownership does have a firm impact on farmers' access to credit. And also we are looking at whether foreign ownership can reduce the farm's credit constraint, and the results here in terms of the different classification of African bank presence, that's Pan-African bank presence, foreign bank presence, plays an important role of different magnitudes in removing the credit constraint. And this is done just to embed our story. The study which started with the competition ends up with bank lending, and then verifying the credit access and credit constraint argument, which is, of course, consistent with literature. And even when we look at this in terms of the industry, suppose we have the industrial classification where the farms are divided into manufacturing, services, and other, we still find that these results still hold. So a number of things that we want to conclude with in a kind of observation. The fact is that there is evidence here in this paper that the expansion of Pan-African cross-border banks into the WAEMU banking system as a homogeneous system with heterogeneity has enhanced competition in the regional banking sector. And maybe this is the nature of the way the banks have spread, and I think this is where JDIP was trying to look into. It's not necessarily by M&A, by merger and acquisition, but possibly by greenfield investment type of work. And one can look at this by actually looking at the nature of shareholdership and nature of investment of each of these over the years, and how banks have metamorphosed. This is quite where there's a kind of a degree of banks coming together to be able to compete, the Pan-African banks coming together to be able to compete with foreign banks. Okay. The second conclusion is basically that the enhanced competition has increased bank lending in the WAEMU region. And thirdly, that increase in bank lending is consistent with the increasing the firm's access to bank credit. Okay, and the effect is much higher in cross-border Pan-African banks, and this may point to say maybe relationship banking, the use of relationship banking that run collateral, given that some of the Pan-African banks have grown out of microcredit institutions, especially those operating within the WAEMU. Now, we can take a look into some important policy implication. I think the regulatory issue is absolutely important because WAEMU adopted Basel III guidelines on January 1st, 2018. But the literature, the evidence here seems to be leaning towards the argument that the increase in minimum capital requirements of operating bank is very important, but also that this affects the results of the expansion of these big Pan-African banks operating and being able to withhold competition, and then endogenously enhancing the competitive environment and bank lending is particularly important, which would mean that we do have a regulatory variable in the equation, which has also been validated, and regulation becomes an important argument in terms of policy implication, not only in terms of regulation, but also the quality of regulation, which is the supervision. And although these changes will provide more capital buffer to banks and maybe more financial stability in the region, another factor that we have also looked at kind of separately. But if the growth is expanding into big business, into better businesses. The evidence on farm lending suggests then that, of course, is an enhancement of financial stability. And an indicator of Z score that we have used in the argument in the empirical investigation tend to support this. So the other application that basically more likely the big banks will increase their lending, access to financing for SMEs will increase, but mainly coming from small and medium-sized banks. But there are challenges in here in terms of the variations in the size of banks and how this can contribute to basically to financial inclusion eventually. Now, there's also an implication about alleviating credit constraints facing firms. And the evidence seems to suggest that to alleviate credit constraints facing firms, one will need to implement some specific policy, given the positive evidence. To further embed this, maybe to look into issues like credit guarantees for SMEs, and then financing window of SMEs at the regional exchange. That could be a great follow-up on the back of the evidence. Okay, but overall, the paper, I think, has helped provide the regional banking authorities in terms of the West African central banks a very deep and granular understanding of the banking sector, the role of Pan-African banks versus the foreign banks, especially the French banks, and how to create a better environment for farm financing, especially small farms. Thank you very much. And I will stop the presentation here and take the comments. So let me try to come back this and stop sharing. And now I can see whether if I go into the chat, okay, sometimes the information comes into the chat with a time lag. And I think the only chat I can see is the question by Deep. Actually, some of the position, some by expansion, but mainly I think it has been by expansion because of the financial liberalization and the international trade, the gross international trade in financial services. Very good to see Issouf, and he's come at timely at the best time when he's going to take the questions, the answers to the questions. Thanks. Let's see, Issouf. Thank you. Okay, so let me see some. Oh yeah, okay. Issouf has a further contribution to make on the paper. So this is quite correctly his co-authored paper.
Yeah,
Issouf, go ahead.
Yeah, thank you very much, Victor. I mean, actually, I was I follow almost all your presentation. Actually, yeah, I came late, but yeah, I came when you were showing the slide with the names of the authors. I mean, thank you very much for these great presentations as always. Yeah, just few things. I mean, you did a very good job in presenting the paper. I just want to add few things. I mean, I know someone asked in terms of the expansion of those Pan-African banks, are they doing it by acquisition or so on? Basically, as Victor said, depending on the region of Africa, really, you observe different type of behavior. For example, if you go to East Africa, for example, you will see it's more likely to see Kenyan banks going throughout the region, actually. Then if you go to Kenya, the type of study we are doing it will be a completely different type of story, because in Kenya, the indigenous banks are the bank dominating the local banking area. But in West Africa, especially in the WAEMU regions, what is really interesting is that we still see that foreign banks are the dominant banks. That's still the fact. For all these years, but it's kind of the landscape of those foreign banks is kind of changing now. Because we used to have a lot of French banks. The big banks were the French banks, the very powerful banks actually, but those banks are not anymore the entrenched banks actually, because you see real Pan-African banks coming in, and then they are very, very competitive in this environment actually. That's what we are seeing in West Africa. And also, I mean, basically, the WAEMU region is interesting because you see we have 8 countries. They are mostly, I mean, French-speaking country. They have the same central bank, and you don't find the same type of really structure, I mean, across Africa. Maybe if you go to the central part of Africa where you have French-speaking country, but this is a really good laboratory for us, I mean, to explore this one. And because also, again, we have this flavor of the French banks there, which are still, I mean, big banks, and then they do cherry picking, they do businesses with for big banks and so big companies and so on, right? That's the reality. But for the next step of this study, Victor said that this is really an ongoing, I mean, work, and of course it is an ongoing work. We are still, I mean, revising the paper, and the nice things now is that we got, I mean, more granular data in terms of the composition of the total assets of the bank, actually. Then we really want to take this study further to look at really, of course, okay, we see that those Pan-African banks, there seems to be increasing lending, but what type of lending they are bringing to the market? Are these quality lending? Are these long-term lending? Are these short-term lending? What type of lending in terms of portfolio allocation and so on? This is the next step we really want to look at it and then to push really into that direction again. Okay, then I will stop here, Victor, and then probably, I mean, we can take the contribution from the audience to improve the paper. Yes.
Thanks so much, Issouf. For that clarification was very absolutely helpful. And Issouf, spent so much time looking into this granular data because also most of the documents coming from Central Bank were in French, and I don't think about them. French would have been helpful in terms of reading the technical terms of the of the accounts. So thank you very much, Issouf, for that clarification. Yeah, I don't know whether Tori, you're asking a question. I just came and see you, but good to see you. Oh yeah, okay. Yeah, your hand is up. In any case, I had already seen you and given you the invitation to speak. Please go ahead. But I think you are muted, so the next step is to unmute yourself.
Yeah.
Yeah. Okay,
yeah. Thank you, Victor, for the presentation. I found it very interesting and engaging. Since this is a work in progress, I wanted to make a point in terms of the sample period of your study. 2000, I think it's 2000 to 2016. And to some extent, I feel it is a bit outdated.
Yeah.
And in addition, you will see that the migration of, for example, Nigerian banks into African countries, they started just around that time, 2014 and 2015. And if you are saying that 50% of these Pan-African banks are actually Nigerian banks, okay, then, and you are restricting your data, your sample to 2015, perhaps you are not capturing enough of what you ought to capture. Since it is a work in progress, I will expect that you expand the data. It's unfortunate that you already put down your slide. I also noticed that in one of your results, your observation was 4,000 plus. Okay, the observation. If I followed your presentation well, and I think I did, you had 121 banks over 15 to 16 years. There is no way your observation could be up to 4,000. I think something is wrong there. Maybe you need to check.
Yeah. Thanks so much, Tolu. Quite rightly, you observed that the data sample, as Issouf mentioned, is being updated. You quite right to observe that is a bit out of date. And I think part of our we've revamped completely the entire data set, because of the new observation and new granular observations, some of them indicating some of the quarterly predictions of some of the variables, and trying to see whether we can to reconfigure the series. And where we have, of course, companies rather than banks, because this data involves data on banks, but also data on the companies, like where we are sharing information on companies, including SMEs and also large banks and large companies. So the update in that. But the revision also is motivated by our current thinking on some of the theories and underpinning the empirical specification. That as we revamp the paper, we are looking into some of those kind of theories. And now, your observation about the Nigerian banks is kind of accurate, and I think the revision of data will enable us to go into the details. We're gonna cross-check carefully on the number of observations and try to see that indeed there is a mechanism in which we have got a high number of some of those observations, especially the nature of the panel. But what we have is actually kind of a two-dimensional panel. Yeah. Thank you very much.
Yeah, Victor, if I just add something on this too?
Yes, please go ahead, Issouf. Yes.
Yes, I mean, for the data, actually, basically, we have two, sources of data, especially the second part of it. That's why you can see 4,000 actually, because the first part was basically the analysis only on the banks. Then if you take only on the bank, then you see this number of it's a much more lower number of in the sample. But if you take the second part of it, because we are combining actually the data on our banking sample data with the data coming from the World Bank Enterprise Service, which are the firm level data actually. Then when you take those data and then you combine it, that's why you came up with, you end up with this 4,000 something like that. Data in the data set on the sample actually.
Thank you. Yeah, that's what I surmise that way because especially where we are going into property models, we had been able to access a huge amount of company level data. Yeah. Okay, and observations, as actually Toru mentioned it quite correctly, for the work in progress like this one, we are looking into dimensions of expanding some of that work. Part of related dimensions of our research in WAEMU has already been published, but the one that reinterprets the financial inclusion story in terms of access to finance by companies, and then the credit constraint configuration is one that will add a lot of insight into this paper. Okay, I can see the hand number one, HID, welcome back, and then a DAC in that order. Thank you.
So this is a kind of a speculative question, Victor. So I noticed that in the sample, there was like these, there were years, for example, in the final year, Togo lost 10 headquarters and 7 ended up suddenly in Cote d'Ivoire, I think, or some other country. And so are these actually headquarters shifts or are they actually new banks coming up? So if there are changes in headquarters, like moves, then is there a way to exploit that information, just like we would typically in a kind of a sort of causal sense, whether there's any kind of difference? First of all, why would a headquarters shift take place? And if it does, then is it going to have a differential effect on the countries where they're operating? It's just I'm not sure if that is what was shown up in the data, but it looked like suddenly there were more banks in one country and fewer in another. So
yeah. This is a very important question, Jaideep, and thank you for raising it. I can understand the mechanisms of the variations across the 8-country sample of why the headquarters are located where they are. Most of the explanation is the related work. When we started this work with the Issouf and Désiré, we're just looking into the international trade of banking and why countries were opening up to international competition very quickly, but others were being sanctioned because they have to wait for 5 years, given 5 years a grace of period to open up to international competition. Some of the banks like Mali, some of the countries like Mali completely opened to kind of international competition, but especially allowing African banks to set headquarters there if they were going to operate. So I think that we will look into this. I don't know whether Issouf has any insight, but it is something we need to look into because actually the actual documentation of the national headquarters and the shifting relates into another different question that relates to regulation. How come that 8 countries, okay, which have signed up the same code, okay, of WTO and the same code of Basel III, are opening up the banks in relative way, okay, being able to host international, but also in the region, there have been a lot of changes. For example, some of the Libyan banks moved. The Libyan crisis broke out some time back, and they actually found home in some of the countries. Actually, even outside the WAEMU region, finding residents in areas as much as Eastern Africa and Southern Africa. So we look into this. I think the question will give us an exceptional insight in some explaining the work and justifying the additional to this work. Thank you very much. I don't know whether you have anything to add, Issouf.
Oh no, I think that's fine. But you see, we'll really look at it deeply, and because somehow, I think this is a real. We have to look at it. But somehow, one explanation, for example, if you look at, for example, Moroccan banks, some of the Moroccan expansions basically they have done it through, acquisition. Then you see, if they have acquired banks, I think they have acquired, for example, banks in Cote d'Ivoire and in Mali. Then you can see a shift from the number of banks, coming from Mali or from Cote d'Ivoire, as in terms of headquarters. Then you can see those shifts, when they acquire those banks, for example. But I think, you are right. We need to really look at that more carefully, actually. Probably you can give us some insight also.
Thank you. And I think also, I think further conversations with our colleagues in the research department of the WAEMU Central Bank would be kind of helpful, since they have insight into the registration of some of those banks in each of the 8 countries. Thank you. Dak. Hi, Dak. Good to see you. Please go ahead and mute.
Yeah. Good to see you, Victor, and great to hear from you. I missed 1 or 2 slides on the end, and I was wondering about sort of any policy implications that have are coming from this work. In particular, if you think about Pan-African banks, is there a sort of a Pan-African implication as well? So, for example, we're working a lot around the negotiations of the Continental Free Trade Area, and it has phase 1. It has services, and at the moment, sort of countries and regions are in the request and offer stage of this, and of course, the financial sector is one of the sectors that is being highlighted as being important. There's also a protocol on investment that is being negotiated at the moment, which may or may not discuss the financial sector. And so are there any implications? So if, for example, regional banks are particularly useful, if Pan-African banks are particularly useful, and would there be implications for market access commitments on foreign banks? One, and secondly, are there particular provisions that you think are important that should be included in Pan-African regulation, so regulatory frameworks, for example, that might be important, and maybe complementary policies at domestic level that can make it work even better. So just wondering whether there is a Pan-African regulatory impact there or implication, or whether it is basically that actually every country need to think about non-discriminatory regulation anyway, and there are few implications for the content of free trade area. Thank you.
Thanks very much. As usual, your insight into policy issues is very, very helpful. I think we did not shine the spotlight on that very important issue touched on of the African Continental Free Trade Area, because it's have the same purpose of trying to open up, and banking is part of international trade, because it's the international trade in banking services, the international trade in financial services, as compared to the international trade in goods and commodities. So I think the role that one of the potential impact sectors for this work would be to align this work to what is happening within the African Continental Free Trade Area, and whether the experience in WAEMU, what implication it has for other regions in the continent. So we'll try to have some discussion on the African Continental Free Trade Area. But you also pointed on something very important about regulatory frameworks, and that's one. In fact, it goes a little bit even like regulatory. It's not regulatory frameworks per se, but also the new issues on a cross-border payment system. In addition to support the growth of Pan-African banks, here are a number of regional countries trying to coordinate their cross-border payment system. Okay, and that can only just support this. So there are a number of issues we should flag up and discuss in the policy implications. It may well be that the results align very well with this policy implication. It may well be that this policy implication are still remaining challenge, and therefore it can be motivating for other work, further work building on what we have done here. So yeah, thank you indeed for those important observations. So let me take this opportunity to thank you all. Thank the participants for being able to come to this meeting. It may well be the case that you have observation which you can share with us. We were also having after the data processing we are doing, have a new version circulated. And also thank Issouf for being able to make it, and the wonderful contributions you have given and the insights. Thank you indeed, and we look forward to the seminar next week. See you once again for another interesting discussion. So thank you very much, and have a nice day.
Thanks.
Nice evening.